For a look at the Fed's future rate path, all of this following Friday's weak jobs report and then what is turning out to be a market sell-off this morning. Former Kansas City Fed President Tom Hoenig, he is now a senior fellow at George Mason University's Mercatus Center, joining us right now. Tom, it's great to see you, and I appreciate it, especially given where things are starting this morning and what we saw on Friday with the jobs number, and then this sell-off that seems to be spurred in part by some uncertainty in Japan that then sort of cascaded here. What do you make of what happened Friday, and what do you think of what's happening right now?
Well, I think, first of all, the economy is apparently slowing. I think everyone now recognizes that, perhaps, but that's as intended. I mean, the Fed's been in a relatively tight mode for some time to try and get the inflation numbers down. So I'm not sure anyone should be surprised by the numbers. It was a little bit on the upside, perhaps, but unemployment is still 4.3%. Inflation still between 2.5% and 3%, depending on which of the two measures you look at. So we are in a slowdown period, and I think that's going to take us further down the road to getting price inflation down towards the goal. Now, the market is reacting, and the market was, many people thought, in a fairly frothy spot to begin with. So that's backing off. But I think the real economy is slowing modestly and will probably continue to slow. But it's not falling apart. I mean, GDP was up in the second quarter. Final demand, while it's leveling off, is still reasonably good. So those are important things to remember as well. And then finally, real interest rates, if you think about the rate, the Fed funds rate being 5.25% plus, and inflation 2.5 to 3, real rates are still above 2%.
Right.
But I think that's by intent to bring it down. So there's probably room to cut, and I think the Fed will do that. But I don't think we should be panicked as much as the market.
Tom, as you've been speaking, the Dow has continued to fall. We're now down. If we opened up right now, we'd open up, down, if you will, on the Dow we'd be off more than 1.5%. I think it was actually worse than that just before.
No, it is.
890 points.
Yeah, I don't know. Fair value is down to 890.
Let's flip this
900
points
on the NASDAQ.
And 900 points on the NASDAQ. Yeah. Tom, one of the questions that's been asked is whether you think the Fed might try to cut before September, given that it now appears that they have been late.
If you're judging by the stock market itself, that's one thing. If you're talking about the economy more broadly, there is pressure there. So, and it wouldn't be, so to answer your question, if the Fed is concerned about the real economy more than the stock market, it could decide to have an interim conference call, meeting, telephone meeting. That's been done. I mean, Greenspan did it more than once or twice for sure, and others. So that's a possibility, yes.
And the real economy obviously is different than the stock market, Tom, but there's something called a wealth effect. And, depending on how far this goes, people certainly don't feel as flush, and companies might look at what's happening and say, why would I hire going into something like this? And, we already saw Intel with maybe 15,000. So, if a lot of those were government jobs, illusory for the past 8-9 months, I don't see anyone at this point being too excited about hiring. And then it kind of feeds on itself, and the stock market becomes the real economy.
If the stock market, if fear takes over, and it has in the past, and you get people panicked in the real economy as well as in the stock market, then you could have a much quicker slowdown in the economy than what you hoped for if you were an FOMC member. There's no question about it, and they have to pay attention to that. But at the same time, you still have inflation well above the target. You have to be mindful of that, and keep that in mind. But there is room to cut when real interest rates are above 2%. There's room to cut
before September, Tom?
I think if the CPI numbers especially the CPI numbers come in this month much lower, then you would have, I think, a rationale for an interim cut. If it came in down well from the 3% number, you could come down. And if I were the Fed, what I would be saying is we're going to follow the CPI or the PCE, depending on your timing. We're going to follow it down. So if it comes down, we're going to move rates down. And that way you take some of the politics away, but you also are, in a way, saying we're going to cut rates in a systematic fashion. And I don't see anything wrong with doing it that way.